Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Massar and Matt Miller. Welcome to our audiences across all of our Bloomberg platforms. A busy day today here, coming up in a couple of minutes. A slew of earnings, including from Netflix, IBM, and Tesla.
Yeah, that's exactly what I'm thinking about. I was just doing a quick check on how they've been trading. Netflix is up about 7/10. You've got IBM just a hair higher, and you've got Tesla down about 0.5%. Kind of a meh trade, if you will. And we'll see whether or not there's a lot going on at all of these companies, Matt, whether or not they outperform or underperform and what kind of trade we see in the aftermarket.
Yeah, well, so far, I mean, whether companies disappoint or beat, it seems like this market continues to march higher, right? Because over the last 2 weeks, every single trading session has ended higher except for Friday, and that was only down 0.1%. So we continue to make higher highs on the S&P, and the breadth, as Abigail Doolittle was showing us, just continues to grow. Now, 65% of companies on the New York Stock Exchange are trading over their 200-day moving average.
I like what our guest just told us. Romaine was asking whether decreased volatility gives investors confidence, and she said what gives investors confidence is FOMO. And there's been a lot of gains that people might have been missing out on if they were convinced a recession was around the corner.
She also, of course, talked a lot about valuations. At least on an aggregate basis, they do kind of look stretched, though I will point out, just to push back on that, yeah, they do on an aggregate basis, but what about on an individual basis? There's a reason why you're seeing some of these second-tier stocks start to kind of pop up a little bit here, because they did not get that multiple expansion that we saw with the Microsofts and Metas and Apples of the world. The closing bells here in New York on this Wednesday afternoon. The Dow Jones Industrial Average higher by 0.3%. The S&P 500 higher by 0.3%. The Nasdaq Composite poking into the green, up less than 0.1% here. Netflix earnings now crossing the wire. Let's get right to it here. Revenue in the most recent quarter coming in at $8.19 billion. That looks like a bit of a miss here. The street was looking for $8.3 billion on average. The guidance for 3Q revenue also coming in a little bit light, $8.52 billion. The street was looking for $8.67 billion. Here's your streaming paid net change for the second quarter. 5.89 million subscribers on a net basis. That's about double, more than double what the street was looking for by 2.07. So it looks like they added a lot more in terms of net paid memberships here, but the revenue mix here not necessarily working there in their favor. The company is saying that it does see full-year operating margins holding at about 18 to 20%. That's pretty much in line with what the street was looking for here. So all around, at least on the surface, this looks like a pretty decent quarter. EPS numbers also coming in slightly above estimates for the second quarter at $3.29 versus a street estimate of $2.85. And guys, the estimate for their 3Q numbers going forward, $3.52.
Well, the bar was high coming into this earnings report, right? You had the stock up about 40% over the past 6 months. And even though that subscriber addition, the streaming paid net change, was so much bigger than what analysts had anticipated, it's the revenue miss for this past quarter and for the third quarter that investors seem to be reacting to right now, down 3.7%. I'm guessing, Romaine, that there's going to be a lot of questions about what the mix is going to look like in that subscriber addition, because it only began in May, the ad tier. So they have a while to work this out.
All right, so let's get to another earnings. United Airlines coming out here after the closing bell. Second quarter adjusted EPS, it's a big beat, $5.03 versus an estimate of $3.99 a share. Also giving some outlook here, talking about fiscal year adjusted EPS of 11 to 12. It had seen 10 to 12. The estimate on the street is $9.80 a share. So you are seeing, no surprise, that stock up about almost 3% in the aftermarket. It's up about 44% this year, and expectations, Matt, were high because Delta really did well and was very optimistic about the second half. So United was going to be held to a high bar, and it looks like, at least initially here after the close, that it is definitely meeting that upbeat expectations. Second quarter revenue, passenger miles, 63.5 billion. That's a beat compared to 62.7 billion. We'll be looking to for international, because there's been a lot of traveling and they've been adding to those international flight offerings. And
this is not a stretched valuation. This is a company with an estimated PE. So next year, earnings for the full year, 5.5. So very low compared to something like a Netflix, which with a forward PE of 42, or a Tesla with a forward PE of 85. Obviously airlines are a completely different segment, but something that isn't stretched at all and still has room to run even after a 46% gain year to date.
Well, when we talk about that forecast and you talk about revenue going up, whatever, in double-digit percentages, low double-digit percentages to be sure, is that what investors are looking for this time around? They want to see that revenue growth, or are they more looking for margin expansion?
Well, you know what? Abigail Doolittle was just on with us, and she pointed out that Netflix is only expected to have 4% revenue growth this year. So, and still, investors are willing to pay 42 times next year's earnings. So it's not like they're paying for growth. It's just FOMO.
Yeah, absolutely. And just speaking, we could go back to Netflix here, Scarlett. We talk about the idea here of what the Hollywood strike, the actor strike and the writer strike could potentially do. We know we have to wait for the conference call for a little more commentary, but they are actually saying here in the press release that they're raising their 2023 cash flow forecast by $1.5 billion because of those strikes. And we know that this has been part of the narrative here, that while longer term this may not be profitable for them, in the shorter term, this actually gives them a little bit more cover on the cost side.
Actually, Jeffrey says that they have enough inventory to last them through 2024. So they're in good shape, at least through 2024. And also they have global production capabilities that perhaps some of the other streamers don't have. So they have a lot of different levers that they could pull.
Well, that caught my attention too. And really that they can maybe weather this easily. And forgive me, Romaine, but if you look at Netflix in the after hours, it's been all over the place. It rallied, it sold off a little bit. It's now kind of flat, Romaine. Yeah,
and I just want to go back to this idea of using that. I mean, we've already heard about a lot of exemptions to this writer's strike, primarily because certain things are being filmed in other countries where the SAG-AFTRA union contracts don't necessarily apply. There are other exemptions as well for certain independent films. So it'll be interesting to see whether Netflix, and for that matter, its peers like Disney and some of the others out there, can also find some workarounds to get some of these productions
done. Or they can just do more sports documentaries. I don't think any of those guys are in the SAG-AFTRA union.
Are you volunteering yourself, Scarlett?
I'm not a professional athlete. I don't qualify.
No, but you have a sports show.
Well, sports adjacent programming. That's what they do. They don't do live sports content. They do sports adjacent.
We're getting LVS. Oh, we're getting Tesla now.
Oh, that's
Tesla
early.
Came out with second quarter earnings of 78 cents, and they came out with the adjusted EPS of 91 cents. The estimate was for 81 cents. So that's the line you want to look at for EPS. 91 cents versus 81 cents is a big beat.
Look at margins.
It's fair to say. And margins is apparently what it's all about this quarter. So Tesla's second quarter gross margin 18.2%, missing the estimate slightly 18.8%, but I think still strong. Revenue at $24.9 billion. We were looking for $24.51 billion. So it looks like Tesla is going to meet or beat.
Yeah.
And the stock is coming down in the after hours.
Stock is coming down. Maybe some of this has to do with the free cash flow numbers coming in at about $1 billion, which I guess under any other circumstance would be good. But the street was looking for about $2 billion. So certainly not an issue in terms of the money they have. But when we talk about the guidance and street expectations, definitely a little bit light, at least on that one metric.
Yeah, and also coming out and saying it's start of a production of, what is Dojo? Matt, do you know this? Dojo training?
It sounds like an AI training computer to me. If I had to guess, I'm going to look in the release right now.
Leave it to Elon Musk to come out with something else that's going to get people excited about, something they're working on, particularly when it comes to AI. But I think what you guys were talking about, the gross margin is the key there, because they need to get that back up to above 20%. Hopefully in the second half of the year is what analysts are looking for. But right now, below that 20% threshold is something to keep an eye on.
Well, we're reporting that actually we're seeing some pressure on the share price because the gross margin is actually missing the estimate. So maybe there is a little bit of disappointment there.
Yep. We're also getting results from SL Green, which is the commercial landlord, at least here in New York City. And funds for operation here beating estimates per share, that is. $1.43. Analysts were looking for $1.34. Funds from operation for the second quarter overall, $98.4 million. Analysts were looking for something in the neighborhood of just over $92 million. And net operating income rising about 16% year on year. We know that SL Green led a rally in REIT stocks earlier this month when it sold a stake in one of its Midtown Manhattan skyscrapers to a Japanese investor investment company that valued that building at about $2 billion. So that was certainly an encouraging headline in what's been a pretty depressing environment for commercial real estate.
Just want to go back to Tesla here. We're going to jump around a bit because we have a lot of earnings crossing the wire. Tesla giving an update on that Cybertruck. Of course, that sort of caught some people's attention on social media when they showed something coming out of a building, not necessarily rolling off the factory, but they are saying that their tooling, the Cybertruck factory tooling, is on track. But I also think this is interesting, Matt. They're talking about how they're focusing on cost reduction and new product development overall here. So it'll be interesting to see what that means.
Yeah, they want to bring down costs to boost their margins, and they have had an advantage when it comes to chips over the other automakers. They also probably want to bring their prices down, as Ford just brought the price down of its truck. Let's take a look at IBM earnings. They're coming out right now as well. If you look at the sales or revenue, $15.48 billion. That's pretty much in line with $15.54 billion that was estimated. In terms of EPS or operating EPS, we're seeing $2.18, and the estimate was for $2 even. So it looks like IBM is beating on the operating level as well as the revenue level. Still sees free cash flow about $10.5 billion. The estimate was for $9.65 billion, so that's a little bit better. And it sees full-year revenue at a constant FX level of +3 to +5%. So a little bit about the outlook. It does say it's excited about the response to its Watson X AI platform, and I hope everyone who comes out with earnings today mentions AI.
Man, they've been lagging though when it comes to artificial intelligence. That's been some of the concerns in terms of everybody else getting into it. The other thing, some concerns about their consulting unit. They did an acquisition. Stock's been kind of lagging. If you look at some of the other big tech names this year, it's just down about 3%. And Matt, you continue to see Romaine too, some pressure in the aftermarket.
Yeah, interesting to see some of the moves in the market here. IBM only down about 0.5% or so. Las Vegas Sands shares actually down though about 4% here in after hours trading. They just came out with their results here. The 2Q numbers look like a beat. EPS coming in at 41 cents a share. That was a beat. Revenue coming in at about $2.5 billion. That was also a beat. And the company reinstating its dividend here. Nevertheless, it's not quite clear. They did not provide a forecast here, and maybe that's causing a little bit of agita here, but you can see those shares a little bit depressed here in after hours trading.
All right, so we're seeing Las Vegas Sands down about 3%. You've got IBM on the move, a little bit lower in the aftermarket. Quick check on what we're seeing with Tesla. It too is moving in the aftermarket. It's been bouncing around. It's now up about 1.3%. So certainly some of the names that will continue to track in the aftermarket and into the Thursday trade. All right, guys, that's a wrap. A lot of earnings for everybody. We will see you again for Beyond the Bell and Countdown to the Close. Join us on Thursday.